Is Excel
Yes,
is
sir. Yes, yes,
okay.
it
Yes,
is.
sir, before moving to the class, actually, you have submitted the details of the project on the LMS. So
Hmm.
that notification we could not receive on the mail, and because of that, we could not able to submit the titles. So because of that, means probably in coming 2 days, we will submit the project titles to Sachin, and after that, he will say the details.
Yeah, how many know that there is a project which was given and the deadline is already passed?
Sir, we could not check that on LMS actually.
So let us
Actually, yesterday I have dropped a mail, and over that you have said that you will try to connect with the Sachin. So I was thinking that you will probably you will mail to us, and after that we will have to submit the project
yeah,
title.
correct. So Sachin Verma, hope he is here.
Yes, sir. Yes, sir. I'm there.
So you can see the project details are actually given here. You can go through this.
Okay.
So it is given here that it is an DCF valuation of a listed company valuation. You'll be doing it. And there are two components in this project. The first one is you'll be computing the weighted average cost of capital. That is cost of capital, how to compute, which I'll be explaining you in today's session. And once you are through with this session, okay, so you know how to compute that. And the second part is DCF valuation, how to compute. And you already know it, how to compute DCF valuation. So you should be selecting a company. Means you have got groups which are actually made by IAM, right? IMR. Okay, so based on this particular group, what you do is you have to choose a group leader, and the group should also take up one listed company, and the criteria for taking up any listed company is also given up. It is given here. You can go through it, you'll understand. And once you choose the company, you should be submitting what is the name of your company. I'll go through the company. If there are any overlappings, then I'll ask any one particular group to change the name of the company. So this is what I was thinking to do. So once you submit, but unfortunately, none of you in fact submitted, and Mr. Sachin also did not come to my contact. So that did not really happen at all. Okay. So Sachin, will you be doing it in the next 2 days?
Yes, will do, sir.
Shall we extend this to first deadline?
Yes, please.
So today is 12th. At what should be the deadline? You tell me, because now
By 14th, we'll give you, sir. By 14th, end of day.
15th.
yeah. So
15th, end of day, we'll do.
15th is fine.
Yes,
Yes, sir.
So 15th EOD should be submitting this. In turn, Mr. Sachin will mail to me.
Yes.
I think you have my email ID.
Your Gmail ID, right?
Correct.
Yes, that is there.
I'll just put it in the chat box as well. Okay. So if anybody wants my number, it is already given. So this is my number. Is it fine?
Yes, sir.
So today we'll be discussing the computation of WACC part 1. So part 2, everybody knows it already, because discounted cash flow valuation we already learned. We have discussed it, Okay, so there are some sets of guidelines here, and you can go through it, and you can submit within the deadline. Okay. So don't miss your second deadline. Okay, it is almost a month. It is, you can see when is the second deadline. It is 8th June. Okay, you got ample of time. Hope we will not miss this deadline.
Yes, sir.
Okay. I am not going to extend this 8th June. Let it be here as it is.
Okay.
Fine. So any doubts you have, class, before we move on to the cost of capital? Yeah. So tell me, what is this cost of capital, just in case anybody knows this?
So the cost of raising funds or rather capital, in form of equity or debt forms,
Okay.
And that is basically the entire cost of capital that the company has.
Yeah, so that is exactly the cost of capital is. So can you tell me what else it is actually called as? Cost of capital is also called as what? Any idea? Okay, so you must have heard this WACC.
Weighted average cost of capital, yes.
Yes, right. So have you heard of this? One more is, have you heard of this anytime?
No.
Yes, this I have heard. Opportunity cost of capital.
Opportunity cost of capital, discount rate, required rate of return. Okay. So all these can be used interchangeably. All are same. Is it fine? Okay. So now let us go now and see how to compute this cost of capital. We'll be discussing in today's session. Okay. In detail, we'll be discussing. So how to compute this cost of capital. Okay. So you got various funds as such. The first one we take into consideration is equity share capital. Okay, so equity share capital, everybody knows it. What is equity share capital? It's owners' funds, in other words. So how to compute the cost of funds of owners' fund? Okay, so first what we do is we'll compute how to compute this weighted average cost of capital. Okay, so let us name this company as Prashant Limited. Is it fine? It's a listed company. Let us assume that it's a listed company and the name of the company is. So this is the name of the company. We have actually named it. Okay, so how much is the value of these shares? Let us actually write down here. I'm just going with the approximation here. I'm just making some assumption. Assuming that there are 10 crores shares outstanding. Okay. And when company has issued this for the first time, it has issued this for the 10 rupees face value. The face value of the company is 10. I multiply with the total number of shares. There are 10 crore shares multiplied by 10. I enter, I got some number. So what is the total book value of equity share capital?
100 crore.
It is 100 crores, right? So let us now go with the market value of the company. So though it is issued at 10 rupees, what has happened of late, the company kept on making some profits, and what the company did is it kept on, in fact, transferring some part of the capital, some part of the the profits to back to the company, and because of which the company has also grown. Okay, so let us assume that the current market price of this 10 crore shares, okay, multiplied by it is 2,850 is the current market price. I am just assuming, okay, Prashant Limited is share price in the market is 2,850 and there are 10 crore shares outstanding. Okay, so how much is the total market value? Anybody can tell me now? What is the market value of this firm?
2,850
28,500 crores.
Yeah, so 28,500 crores is the total market value of the share. It is market value of this company is this much. Hope it is understandable, everybody. Okay, we have been discussing what is market cap and all that in the previous sessions as well. Okay.
So 2,850 was the price of one share.
Correct.
Okay.
Okay, so 2,850 was the share price. Supposing if you want to trade in Prashant Limited, you have to shell out 2,850 per share. Okay. Next is, let us go with the cost of funds. Okay. So how much is the cost of funds? I'm just assuming this for the computation of cost of capital. We'll come and discuss how this 13.5 will has come up here in detail. But for time being, let us assume that it is 13.5. Later, let us discuss how this 13.5 has come up. Okay. So company has got retained earnings as well. So company has got retained earnings. Company has got some 100 crores as retained earnings. Fine. Okay, can you tell me how much is the market value of this retained earnings?
It will affect EPS.
Okay, so the market value and the book value of the retained earnings will be same. We should not be computing the what is the market value of the retained earnings, because it's the profits which has been flowed back into the business itself for a period in time. So book value and market value will be same it is. Okay, in other words, we should not be going out and doing what is the what is the market value of this retained earnings, because there will not be any market value for this, because it is utilized inside in the company. Okay, so because of which what I'm doing is market value will be equal to this. Let us come to the cost of funds later. Let us go to the next one. Okay.
So it is not clear, the retained earnings.
If you have understood retained earnings, then this part you must have understood. So tell me, what is retained earnings now?
No, that is what I am not clear about. Means how did we get this value?
See, this retained earnings value, this is a hypothetical figure, some 100 crores I have taken.
Okay.
Profits which are back in business.
So over a company is in existence for the last 20 years, and the company is making consistently some profits, and those profits are actually flowed back into the business. They are actually added back to the, they are retained in the company itself.
Okay.
For the growth prospects. That is the reason it is 100 crores is there in the company itself. Okay, so let us go to the next component, debentures. Okay, so company has got debentures. Okay, so let us see how many debentures are there. Company has got 10 crores debentures, and when company has issued, the face value of these debentures was 100 rupees. Okay, so I'm just taking hypothetical figures here to make you understand what is the cost of capital. It is something like building our own case. Is it fine? I thought because I actually went and saw many Harvard cases and Ivy cases, but what I found was for 2 hours discussion, because many of you don't know what is cost of capital. Okay, so it was a very slightly and higher level case which were available there. So once you know this much, then only I can actually go out and use those cases. That is the reason I thought, let me build my own case here, something like an assumed case here, so that it is going to be helpful for the class as a whole. Otherwise, understanding the concepts itself is going to be taking much of our time. And the moment we end 2 hours, another 2 hours discussion is still left, and nobody understood what is cost of capital. So that should never happen. That is the reason I have taken up this thing. Okay. So tell me now, what is the market value of this? So 10 crores debentures. What are debentures?
Type of a bond.
It is an bond, it is, and it is a fixed income bearing security, right? Everybody knows what is debentures. Debentures means it's a fixed income bearing security. There is going to be a coupon rate and all that which is available, which will be there for that, right? So I'm assuming what is the market price of this debenture is. Debenture is listed on the stock exchange, and it is traded at 202 rupees and 40 paise. This is, I'm assuming, what is the market price of the debentures. Okay, the face value is 100 rupees. It is trading at 102 rupees and 40 paise. Is it fine? So can anybody tell me how much is the total market value of these debentures now? Market value of debentures is?
And there were 10 crore. Initial face value was 10 crore or 100 crore.
So this is 10 crore shares, debentures were there in the company, multiplied by 100 rupees per share is a face value.
1024 crore now. 1024 crore.
Okay, now how much is this?
1024 crore.
It is 1024 crores, right?
Yes, yes.
You can see 1024 crores. Okay. So company has got some term loan as well. Company has taken some term loan 8 years ago. Okay, so when company has what is term loan, by the way?
So long-term loan usually taken by banks or some private financing, usually by banks.
So
It's a
given,
bank
Fixed
loan.
interval.
yeah, for creation of fixed asset.
Okay, so it is just a loan. It is. You have to understand that bank has taken a loan of some crore rupees, which has got a maturity period of 8 years. Is it fine? Okay. So this company has taken 15 years loan. Okay. So 8 years loan which has taken company. Sorry, I'll just write it as it is an term loan for 8 years. It is. Is it fine? Not 8 years ago. It is term loan company has taken for 8 years. Is it fine? Okay. So since 8 years is there, the company is supposed to be repaying this loan in 8 years. At the end of 8 years, this loan should have completely paid off by the Prashant Limited. That is the reason it is actually called as term loan. Okay, so term loan means why term it is called as term? Because it is given for a certain period of particular number of years it is. Okay, that is the reason it is called as a term loan. It is given for some term. Okay, and it should be repayable at the end of 8 years. Okay, so let us assume that the company has taken some 200 crores term loan. And as usual, what happens in this with this particular case is this term loan will not be having any market value. If I ask you still what is the market value of this term loan, there is no market value because this is not going to be get sold in the open market, right? Because company has taken bank loan, there is going to be only book value. Only there is going to be only book value for the term loan. The market value of the term loan will not be there.
And what about the interest?
I'll come to that. Interest, I'll come to that. Okay. So what I'm trying to say here is, if you still want to ask me what is the market value of this particular loan, okay, that I say that it is equal to book value. It is equal to book value because there is no market value at all. It is only for the competition sake we are writing there. What is the market value and the book value? Okay, precisely for equity share capital and debentures, we have got separate market values. But for retained earnings and for the term loans, we don't have any market value. Okay, but he should have asked me, so then when there is no market value, then why is it you're writing in the market value column? Okay, I'll come back in a minute and I'll explain you why is it I have written there. Okay. Now, can you tell me now what is the retained earnings? Tell me, since it's an assumed example, how much should be the cost of funds for the retained earnings? Can you make some assumption and tell me?
So equal to the opportunity cost, standard opportunity cost, maybe the FD rates.
Equal to FD rates.
Yeah.
Okay, FD rates. Any other answers? Can you put it in your chat boxes? What is that you're thinking? What is your assumption about retained earnings? Make some assumption, wild assumption, and write it in the chat box. How much you're thinking? Because now you know a reference point. Equity share capital is 13.5% is the which is given to us, which means I assumed it. Now you know how much is the equity share capital. That is the cost of equity. You know it now. Can you tell me what is retained earnings cost of funds? Assumed value. Okay, so Mohammed is saying that it is inflation rate. Yeah. Any other answers? Any other answers? You have to just guess and write it. I'll give the right answer after some time. Yeah, go ahead. If you start thinking, then you'll get your answer. You know the reference point, cost of equity is 13.5%. I know it is very difficult to guess as well.
Retained earnings, something accumulated profit that the company keeps and not distributes among the shareholders, right?
Correct. So Mohammed is saying inflation rate. Abhishek is saying that previous year's operating profit percentage. Okay. So Vaibhav is saying that government bonds rate of interest because he don't want to take any risk for that maybe. So he has written that. So Rekha is saying that generated profit. Okay. If the profit is, let's say, profit percentage, okay, when it comes to sales, okay, so let's say, for example, net profit margin is, let's say, 60%. There are some companies which gross profits are going to be 60%. Net profit margin is 60%. So are we going to say that the cost of funds is 60%? Think about it. Mayank is saying the rate at which stakeholders want grow their money. Okay, so Mayank is near to the answer. I think he can make some more guesses. If you want, you can write one more guess. You're almost near. You're almost 95%. Okay, so Varun is saying growth rate. Okay, Sachin Verma is saying that it is equal to retention rate. Great. So retained earnings and retention is both are the same actually, is it not? Retention rate
Okay.
means supposing that if company is retaining 80% of the total profits, 80% should be the cost of funds. Is it really good? A way of saying.
Isn't it the amount that is kept in the business for, I mean, further for the business use only? So just
Yes,
like
it is
dividend
used
is
for the-
paid.
No. Dividend is paid out of profits, right? Assume that 20% is paid and 80% is retained.
So the amount left after paying the dividend, that is, I guess.
So that is exactly is in 100 process. That is how the 100 process come up now.
Okay.
Okay. Think about it. How much is the cost of funds for that? Equal to retention rate. Okay. Next is profit percentage. That is what Naresh is saying. Dhirenkar is saying market growth rate. What market here? It is the Sensex growth rate. It is. Or Nifty's growth rate. That is what Dhirenkar is trying to say. I don't know. So next is 13.5. That is what Shivam is saying. Market rate. Deepesh is saying. Okay. I don't know what is market here. So Preeti is saying that 13.5. That is more than 13.5. That is what she's saying because cost of equity is 13.5. It should be more than 13.5. Okay. So next is Soam is saying loan rate. So if you go and take some loan in the market, how much your bank is charging, that is the rate it should be. It should be okay. Fine. So forecasted growth rate, Mohammed is saying. Satyapal is saying market growth rate. Naresh is saying the return shareholders could expect. How much is that? That is what is my question actually. So next is required rate of return. Okay. Interest rate, company growth rate. So among them, the right answer is
More than
Shivam's answer
13.5.
13.5%. Why? Because equity shareholders is expecting 13.5%. And ultimately, this retained earnings belongs to whom it is? It belongs to equity shareholders themselves, right? So that is the reason it is exactly equal to 13.5%. Hope you understood the logic. Why is it actually it should be equal to equity share capital funds. It is equal to cost of equity, in other words. Any doubts here?
But it is after paying the dividend, you said. After paying dividend.
After paying the dividend, this much is retained in the company. You're right. You're right. But this particular money belongs to whom it is? Ultimately, if I'm not declaring it as dividend, one or the other day I should be giving. I should be giving this to the equity shareholders themselves, because this money you cannot promoters cannot take. It cannot. This money does not belongs to the debt holders, not the bond holders, not the bank. This money belongs to equity shareholders themselves. So if you know what is cost of equity, in other words, you also know what is cost of retained earnings. In other words, okay. Let us move on to the next one. So debentures, the debentures, cost of funds of debentures. Can anybody guess how much should be this debentures? Because it's an assumed example. Can you put it in the chat box? Let us see. Debentures. Can you think about it? How much should be the debentures company must be? Yeah, the hint is what Mohammed is saying. It should be lesser than 13.5%, because he must have compared the rate of returns with maybe the rate of returns. What is the government bond is selling it? If the government bond is selling at how much is the government bond is selling at? Let us go and check what is the government bond. So the government 10-year government bonds yield is 7.08%. Okay, now you got the reference rate now. So now tell me how much debenture should be there. Nothing wrong or right here. We want to slightly move towards approximation. That's it. Some approximation we should be doing. That's it. You know, it should be 13. It should be lesser than 13.5%, and it should be more than 7.09%. Why is that? It should be more than 7.09%.
Otherwise, people will buy government bonds.
In other words, your company is riskier than the government as a whole. That is what is the assumption we are making, right? And that is a safe assumption to make, right? Your company is not risk-free, right?
Right.
Company can get default, right? Unlike government. Okay, so thinking that Indian government is going to get bankrupt, it is not going to happen at least for the next 10 years or so. Okay, so unless we are going to have some extreme things which is happening. So that is the reason what I'm saying is your debentures should be more than that is a logic I'm giving it to you. So if you take a housing loan, how much is the rate of interest? If my
9%.
8 to 9%.
8 to 9.
Okay, so 8 to 9%. So that too, you have got a good credit score. Somewhere around that, I would like to have that my debenture. That is what I'm thinking, that this would be my debenture rate. Hope you're understanding what is the thinking going there actually. Is it fine? Again, it's an assumption for me. Okay. So tell me, how much is the term loan now? Companies must have taken
11%.
12%.
Let us take
11%.
11%.
Okay.
Fine. So somebody would argue that it should be 10%. I can change it to 10% because it's just an assumption. It is okay. There is no hard and fast rule that it should be 11% or something of that sort. It is okay. One thing what we can also do is we can go to State Bank of India's website and check what is the rate of interest for 8 years or more than 5 years term loan as well. That is one way of looking at it. I'm just taking that because I want to save some time. That is the reason I just did 11%. That's all.
So can you please tell about debentures rate is 9.25? I'm not getting it.
9.25. Yeah, anybody would like to explain why we have taken 9.25%?
So I'll give it a try.
Yeah,
So if you see the equity from the cost of funds for others is 13.5, and the government bond is at 7.09 something. So what we assume is that it will be somewhere in between.
yes,
Because if it is less near to 7, then certainly people will buy government bond. They'll not buy our bond.
because your company is riskier than government. You know?
Yes,
Yeah.
companies, any private company is riskier than government. And secondly, if it is more than 13.5, then there would be other ways to maybe dilute further share or something like that to raise the cost of capital.
Okay. Hope you got your answer. Somebody asked the question.
Yes, yes, sir.
Okay. So let us now go through this. Now we have understood what is cost of funds, how we have actually computed, but this is not the right way of looking at cost of funds. I'll explain you how to compute this in some time, but because we have to make some assumption, that is the reason we have made some assumption here.
Sir, one more small thing. So another thing is there is that this debenture percentage would be lesser than term loan also, because the company, if it can take a long-term term loan at a why would it offer debts at debentures at a higher interest rate than the term loan which it can take, right?
It can take place. Yes, correct.
Okay,
There are multiple ways of looking at it. Okay, so the more you get to know about the aspect, more doubts you get to have in your minds. Okay, and that's how it is. So let us go. Since it's an assumption, let us keep it that way. Okay, so can you tell me how much is the weights of these funds? I want to take out the weights now. Now I am confused whether I should go for market value weights or book value weights. Because ultimately what should I do is I should compute the WACC here. What is WACC? How to compute WACC is WACC is equal to weights multiplied by cost of funds, respective cost of funds. So tell me now, which weights I'm supposed to be taking, whether I should be going for the book value weights or market value weights, and why? Okay.
Market value should be there.
Market value should be taken. Yeah, any other answers? You can put it in the chat box as well. Book value or market value. BV for book value, MV for market value. Okay, so Mayank is saying market value, Dinesh MV, Sachin is also MV, Sharad Kumar is saying MV. Yeah. So now I would like to ask the question. So why is that we should go for market value weights? And if you don't know, you can put it as don't know as well. Okay. So why we should take market value weights? What is the rationale behind that?
Because the book value is the time of the book value is very old. So today the WACC should be calculated. What is the cost today? So weights should be taken for as on date only, not the previous ones. Maybe.
Yeah. So what you said, what Sachin is saying, trying to say is correct. It is so because when company company came into existence around 50 years ago, when company has issued 10 rupees as a face, same with respect to State Bank of India. So company came into existence around 80, 90 years ago. When company issued its shares, it has issued at the 10 rupees only. Okay. So later on, what has happened? Company started earning so much of profits, and it is there into the business for quite some time now. And what has happened is company has also grown into leaps and bounds. Okay. So taking book value, if you compute, you'll be computing the cost of capital when company has started. That would be the cost of capital you'll be arriving at. But why we require this cost of capital is this cost of capital, it has been required for the valuation of the companies, as we have discussed in the last class. This same WACC rate we'll be using, right? So you're valuing a company today, or you want to value a company 50 years ago? Since you want to value a company today, as on today, so WACC should also be a fresh WACC. You should be using it. That is the reason we should be the most appropriate way of using cost of capital means finding out the cost of capital is you have to go for a WACC which is actually reliable or which is relevant right now. So because of this reason, we take market value weights. So having been said that, let us now go and compute the market value weights now. Any doubts here, class? So now I compute the market value, because before that I should also compute how much is the sum of this, right? So this is the total value, total market value of the all the sorts of funds we can actually raise. Okay, so how to compute this market value weight now? This divided by what? This, and I fix it with F4 and I press enter, and then I double click on it. I must have computed the market value weights. So I'll just make a summation of this just to cross verify. It is summing up to 1, which means it is correct, right? So now, so can you please also compute like this, what I'm saying? If you're doing along with me, you can also do along with me like this.
Sir,
So next-
why are we adding term loan? We should actually minus the term loan, right?
Okay, so term loan should be deducted. Why?
Because that is something which we have to pay off.
That is supposed to be paid off, but that also comes with the cost of funds, right? For term loan also, you have to pay something as cost, right? We are trying to compute the weighted average cost of capital, which means whatever the sources of funds are there, we are taking into consideration, and what is the cost of those funds, and we are actually going to be cross multiplying with both of them. That is with the weights multiplied by the cost of funds to arrive at the weighted average cost of capital. If you then the debenture should also be deducted then. Even the equity share capital should also be deducted then. Okay.
Sir, what is the value in your debenture cell
What is it?
C12? Can you go to C12?
C12.
It was multiplied by 102.4.
Yeah. Fine. Yeah. Any doubts? Are there any minute doubts also? No, welcome. Go ahead and ask me.
You didn't multiply it with the book value.
That is what book value. I'm not considering it.
No. I'm asking for this market value of debentures is not book value into 102.4.
Is it?
It is.
You can see whether it is 10 crores or not, first of all. It is 10 crores multiplied by 102.4. In this case, you can see it is 100 multiplied by 10 crores.
Okay, so 100 was the value, 102 is the current value. Okay, understood, sir. Thank you.
Understood, right? Okay. So now I would like to compute WACC now. So how to compute WACC is market value weights multiplied by cost of funds. Okay, so how to do that? You know that it is just a cross multiplication. So now this, I will be making a summation of this. I got some number. Okay, and this is my weighted average cost of capital. So I can also use sum product function. So how to use for sum product? That is cost of funds, comma, weights. I should get the same answer. Any doubts are there? What is this weighted average cost of capital? How it is being computed? Hope there must be no doubts now with respect to weighted average cost of capital. Somebody says that cost of capital, which means he is speaking about weighted average cost of capital. It is. So why this weighted average cost of capital is important for us? Can anybody tell me? Why we should actually know what is cost of capital of a firm?
So it is important for understanding both project financing, whenever they're doing some sort of project appraisal or for new product or something.
Correct. Supposing that there is a project which is coming up now. So you have to, what is that you do is you will be, whatever the future cash flows are there, you are going to discount it back to the present value terms, right? So what is that rate of discount rate you'll be using it? If you don't know the WACC, so you will not be able to in fact evaluate the projects. Okay, we'll be discussing even how to compute the NPV IRR in the next session. Okay, so at that point in time, you will be understanding in a greater detail. Okay, so the WACC is very important, which means this is the discount rate. Okay, this is the discount rate. What you'll be using is for all the projects, you'll be evaluating using this 13.34%. Okay, supposing that now you take into consideration of this WACC, any project is going to give you a return, let's say lesser than this 13.34%. Will you still accept that project?
No.
So your common
No.
sense is now saying that we should not be accepting any project if it is at least not earning your cost of funds, because it is going to be a commonsensical thing. It is right. You borrowed funds at the rate of 10%, and you are actually making, by doing business, you are making some 8%, which means there is a gap of 2%, which means sooner or later you will be out of business. In other words, okay. So that is what is actually coming to your mind, right? So you should not be investing in any project which is not going to earn minimum acceptable rate. What is the minimal acceptable rate for us? 13.34%. The WACC is the minimum return which a company must be earning out of its project. If it is not earning, then definitely we should not be going ahead with that particular project. And that is why every employee of the organization should know what is the WACC of your own company, in other words.
So this 13.34 is no profit, no loss, isn't it? Or do we have some profit in it?
No, that is
If some
actually,
project is returning on this rate.
no, if you get 13.34, okay, you can
Exact.
actually satisfy everybody else here.
Okay.
Is it not? So your equity share capital, your cost of equity is also been, what is that projected here, right? 13.5%.
Yes.
Which means you can satisfy everybody else means, okay, minimum to minimum 13 point, what is it, 2-3%, how much ever we have actually computed as WACC, okay, 3-4%.
Yes.
So we should be getting it from the project. Otherwise, we'll not be able to satisfy. Okay.
Okay.
Okay. Supposing if your project is going to give, I'll ask you what Sachin, what question you have asked in a slightly different way. Okay, you got a project proposal and you evaluated. Okay, you are actually going to get the return exactly 13.34%. Are you going to accept or you are going to reject?
Reject.
Reject, because some profit should be there, isn't it?
I am saying that 13.34 exactly if you're getting, okay. So academician says that we have to accept the project. because we are
Okay.
actually satisfying everybody's else motives here. Okay. So equity share capital means what it is. The shareholders' expectations are also we are inbuilting. Retained earnings means again it belongs to equity shareholders themselves. Next comes the debentures. We should be able to pay off the debentures as well, and we could be able to pay off the term loans as well. And we could
But this is
able to-
as per today's market value.
Pardon?
But this is this is as per today's market value. So when the project is
Today's
installed,
market value, and whenever we actually compute this project, on that day we'll be computing the VAT.
okay.
Just in case.
So within 6 months or 1 year it changes. So definitely it's a dynamic, isn't it? Or it doesn't change for a year.
Not like that. It keeps on changing. I do agree with you. It keeps on changing. Nothing is actually going to be permanent here. At least when we evaluate the future cash flows of the company, we take into consideration of that, right? And because of
Okay.
which, supposing that if you're taking, let's say 10 years as your 10 years project you're taking means, you're taking, what you have to be doing is the risk-free rate what you take for computation of cost of equity will take into consideration of 10 years risk-free rate there. We'll discuss when it comes to cost of capital there, that is equity cost of capital there, you'll understand. Okay, how to actually take into consideration if the project is long term, how to actually inbuilt your cost of capital, we'll discuss when we come there. You just remind me, we'll discuss that. Okay.
Sure.
Supposing if your project is 30 years, so how to compute cost of equity at that point in time? I'll take a risk-free rate, slightly risk-free rate for that particular project, which is having 30 years, what is it, yield, government bonds yield. Getting it? So that we can make that alterations. Okay. Okay, so this is by and large is actually called as WACC. Now what we do is in the next few minutes, what we discuss is how to compute cost of equity, how to compute cost of debentures, how to compute cost of term loans. We'll be discussing in next few minutes. Is it fine now? So after understanding this, we are going to go with the cost of equity capital. How to compute this, we are going to be discussing now. Okay. So there are two ways of computing. The first method is Gordon's dividend discount model, and the second one is Sharpe's capped asset pricing model. These are the two models which are actually predominantly used by companies for computing the cost of equity. These are the two models. Okay, so we'll be discussing one by one. Okay, so let us go and discuss what is this Gordon's first method, that is Gordon's dividend discount model. And you have to understand that the Gordon's the dividend discount model is only applicable for the firms which are going to be paying predominantly paying dividends, and it is not applicable. This particular model will not be applicable for the companies, okay, which are not paying out the dividends. The companies like new age companies like Nykaa, Zomato, they are not paying out any dividends, right? Still, okay. So for those companies, this model is not possible. Okay, so RE stands for what? RE stands for cost of equity. It is cost of equity or the cost of equity capital. Okay, so this is D naught multiplied by 1 plus growth rate divided by the market price plus G. Okay, so this is the equation which is actually proposed by Gordon. Okay. So what is D naught? D naught means current dividend it is. What is D naught? D naught means current dividend it is. So current dividend is how much for us? We should be taking into consideration of 31st March, the 2024's or 31st March, whatever the annual report is there, how much over the dividend the company has paid in 2024, that should be taken into consideration. That is your D naught here. What is G here? G is the growth rate of dividends. It is. What is G here? So I'll write here what is D naught. D naught is current dividend. Current dividend, which means 2024 dividend in our case it is. And what is G here? growth rate. What is MP stands for? Market price per share.
So growth rate of what?
Okay, so this growth rate, okay, for a dividend discount model, we normally assume the growth rate in dividends. Okay, so I'll write here growth rate in dividends. Sorry. This is the growth rate in dividends. It is. So now what we have to do is we have to compute the growth rate in dividends. Prashant Limited's it's a hypothetical company. So we'll take up the dividends from 2006 onwards. How much is the dividend which the company is actually declared to the as dividends to the shareholders? So I'm just stopping it at 2024. So this is year dividends. Okay, so the company started paying at 2006. Company has paid dividend of 7 rupees. These are the assumed figures. I'm just making an assumption. Okay, so 8 rupees and what the project you're doing, right? For that project, you'll be taking up the dividends paid by your company, literally. Okay, so company did not, company paid same dividends 11, 12, and 13. It is possible, right? Quite possible.
This is dividend percentage.
This is the absolute dividend that is in rupee terms.
So
Sure.
dividend
Rupees.
These are the dividends in rupees
Per share.
per share. Okay. Dividend per share, DPS, dividend per share, right? Okay, so these are the dividends which company has paid, and you can see company did not change anything for some years. That is how exactly happens in the real life as well. Okay, so can you now compute the growth rate in dividends? Anybody is working along with me? Just in case, just raise your hand.
Yes, sir. Yes, sir.
Okay, fine. So tell me how to compute the dividend growth rate.
What is G here? G is growth rate. Okay. So we'll calculate growth rate first then.
How to compute growth rate?
Are we calculating
CAGR? 7.25 minus 7 divided by 7.
Okay, so raw returns, right? You're holding period return.
Yes.
Any doubts here? We did it in the last class, right?
Yes.
This will be CAGR.
Correct. CAGR of dividends, in other words, right?
Sir, can you just scroll down a little and just copy some values?
Sure.
Thank you, sir.
Sure. So we have computed the returns now. Okay, so how to compute now the growth rate? Anybody would like to tell me now?
You mean RE? Growth rate. This is the growth rate, isn't it? Growth rate in dividends we have worked out.
This is actually yearly growth rate, right?
Yearly. Okay.
We want
Yes.
a comprehensive growth rate of dividend, CAGR.
Average.
Average, you want to take it up. Think and tell me how we have computed.
I think we need to take out the geometric mean.
Correct. Very good. Shall we do that? Is equal to geo mean. So we are not getting this, you can see. At least I am unable to get this. Right? Shall we go for the long method, that is product raised to what? 1 divided by
Time.
count, right? Have I done any mistake?
So -1, I guess.
-1, right? But don't you think that we have not added 1 to this? Is it?
Yes, yes.
Yes.
Yes, sir.
Get a mistake, right? Let us see geo mean whether it works here. It works, it's good. It is working, you can see.
How?
It is working, right? In one step, we are getting the answer.
Okay, okay, okay. Minus.
So this is the return. This is return plus 1, right? Class, any doubts here? What we did?
Sir, can you show that actual formula for product which you did?
Product, I deleted that. Okay,
Okay.
I'll do that as well.
No issue.
0.01.
So product raised to 1 divided by count -1, right? Hopefully we should get the same answer. So there are two ways of doing it. How many got 7.21? Just put it in the chat box. Let us see how many are doing along with me. Soham,
I'm not getting return plus 1. This parity plus 1.
since you're not getting means what? Why we are adding 1?
Okay, okay, yes.
It is there in the formula, right? It's in the
Yes.
formula,
Let's be there.
right?
Right. 7.21.
Himanshu, Mayank, Abhishek, Sharma, Deepesh, Karthik, Sayali, Soham, Dinesh. Okay, so all are doing it. Fine, fine.
Got it, sir. Got it.
Okay. So now, Tribhuvan, Varun, Sachin, good. So let us now, what is the 7.21 class? This is 7.21 growth rate, right?
Growth rate.
Okay, so what is the market value? We assumed as a 2,850, right? For Prashant Limited. What is the current dividend? Current dividend means a 2024 dividend, 24 rupees and 50 paise, right? So we got all these values. So can you now compute what is the
RE.
RE? That is the cost of equity. Vaibhav as well. Okay. So now compute RE now is equal to what? D naught multiplied by 1 plus growth rate in dividends divided by MP, close the brackets, plus growth rate. How many got 18.13? Hopefully everybody must have got if you have solved this equation properly, right? Okay. Soham is getting that. Sayali got it. Good.
So this 24.5, we had assumed, the whole column we had assumed, the dividend column.
Yes, madam. This whole of this. For your real company, when you do your project, right, you have to take your dividends for your own companies. Fine.
Okay.
Everything else remain the same. Only you have to be taking real
This
time
one
data.
is 8.12. What is the answer?
Yes. I am getting 8.13.
Okay.
Whatever. Yeah. Understood now what is this Gordon's dividend discount model is all about? How to compute this? They as per Gordon's dividend discount model. Shall we go to the next one, CAPM method?
Yes,
Yes or no? Okay. So that's the second method is cost of equity computation. It is CAPM. What is CAPM? Capital Asset Pricing Model. It is. Okay. So what is RE here? Cost of equity is equal to RFR plus beta times equity risk premium. What is equity risk premium? Is equal to, anybody would like to tell me what is ERP stands for here? Hmm? What is ERP stands for? We discussed in the last class. Forgot?
Enterprise resource planning.
No. Who is that? That is equity risk premium, right? Equity risk premium. What is equity risk premium? ERP is equal to what? Return of the market minus risk-free rate. Is it not? Can you write down this? Return of the market minus risk-free rate. So as per this particular model, what all it has been required to be computed, let us see. The risk-free rate, we have to be computing this. Or we should know what is the, we should be assuming what should be the risk rate, which means we have to be assuming some proxy for this. Beta we should be computing. And next one is we should also be computing return of the market. Return of the market. So if we know all the three parameters, we should be able to compute the cost of equity by CAPM model. Correct? So can we now go and assume what should be the risk-free rate?
Yes.
Okay, so let us go now to RBI's website again, same RBI website. So you can see market trends here. Okay. So there is a 91-day treasury bill 6.99 is here. 182 days, 364 days. And also you got what is it? 10 years yield of the government bond also you have got it. And you got 2 years yield because it is going to mature in 2026. Now we are now standing at 2024. So 2 years government bond it is.
So 2 years is higher than 10 years.
2 years
Is higher than 10 years. 7.09, that is 7.08.
Sometime
10 years.
happens.
It
For
happens.
long time, we have the lowest rate returns.
It happens. Okay, you can see here government bond 10 years is 7.08 it is. Okay, and 10 years and 11 years is 7.31. Supposing that now which one to select is actually crucial. Okay, supposing that if you want to do a project proposal which has got, let's say, for example, 10 years as a duration. Okay, so you should be going for the 10 years government bond. If the project is for shorter term duration, you know what, how much is the shorter term it is. So based on which you can choose whether it is supposed to be 1 year, 1 year T-bill or it is going to be 2 years government bond, you can decide. Okay, you
It
can
varies.
see, you can see here with respect to 30 years, we don't have any government bond in India which is being traded. Okay, so supposing what if the government, what if the duration of your project is 30 years? Is it not? It is very difficult to do, at least in the Indian context. Okay, there are some other ways and means for doing it. I tell you how it is normally been done. Okay, theoretically I'll tell you, because practically I'm not going to show that. Okay, so we take into consideration of the 30-year government bond which has been traded in the US market, because in the US market you have got various government bonds which are actually actively traded there. So we take into consideration of that. And what is the default risk of India based on the India's sovereign guarantees risk? You know that Standard & Poor has rated our country as BB, right? BB or BBB, you will get that particular rating. Okay, so based on the default risk, what we do is we will compute the the 30 years government bond which is applicable for the Indian context. Okay, that's a lengthy computation. I'm just want to give you theoretically, I'm going to explain. I just now explained how it is normally done if it is for 30 years or more than 30 years. Okay, so as of now, we'll take 10 years government bond, that is 7.08, assuming that we are computing this for the longer term duration. So I am taking this 7.0.
Yeah, what does a T-bill mean? That for the three
Treasury bills it is. Okay, treasury bills it is. Go find out what is treasury bills in the internet. You'll get to have an information. Okay, so this is government bond which is having a duration of 10 years it is, because it is maturing in 2034 it is. Okay, so it is a 10 years government bond it is. Okay, so treasury bills means it is issued by the Reserve Bank of India for the short term duration, in order to tide over the differences. Let's say, for example, if the Reserve Bank of India is going for 91 days treasury bill, because government supposed to be making some payments which are due for some of the contractors which are in 91 days, which are actually due in 3 months. So when government has got these kinds of temporary difficulties with respect to finances, they actually go out and raise 91-day treasury bills. It may be for the payment of salaries for the government employees as well, and so on and so forth. Okay, so it is basically loan which has been actually means the government of India is taking loan from general public, maybe from the financial institutions, or maybe from the individual investors like you and me. In both the cases, it is. Is it clear what is treasury bill is all about? It is a short-term loan which government wants it, and on behalf of the government, RBI is actually coming out and it is actually issuing a paper. Okay, so that is actually called as treasury bill. And normally, whatever the money which is being actually raised by government of India, that is through RBI, all the securities are AAA rated. Why it has been AAA rated? Because government will not default. If government do not have money, it can print the notes and it can circulate. Is it not? So because of this, okay, so government bonds will not be will be risk. These are actually called as risk free. Okay, clear?
Yeah.
So I'm taking 7.088. Is it fine? 7.088 as the risk-free rate. So we are done with this. Proxy for risk-free rate is our government bond. I'll write here how I got this. RBI website. Okay. So this is 10-year government bond yield. Okay, so that is what we have written here. Clear? Any doubts so far? You can ask me before we move on to the next one. Done, everybody? Shall we move to the next one? Computation
Yes,
of beta.
please.
Quickly, we'll compute this beta because we know how to compute this beta, right? Okay, Prashant Limited is an assumed company, so it is not been listed one. So because of which we'll not be getting the data of company. So we'll take some company. Okay, so let us go for State Bank of India. Okay, SBI historical price data. So we'll compute State Bank of India's beta now, and we will assume that this is Prashant Company Limited. We just have to compute some beta. Okay, I'm just taking State Bank of India. Okay, nothing to do with Prashant Limited with respect to State Bank of India here. Okay, just an example it is, that's it. How to compute beta in real time. Okay, so I'll take up this Yahoo Finance data now. I'll click here. So historical prices, it is here. Do along with me. So normally beta should be computed for the last 5 years. So I'll take 2020. Done. Is it fine? And I'll take weekly because the daily observations will be more. Okay, so I'll take weekly. There are 52 values will be there in 1 year. Okay. See, whichever you want to choose, whichever the frequency you want, you can actually download it. There is no specific, but normally academicians goes with this weekly price. That is the reason I'm just taking weekly. So after this, what I do is I'll just click download. Okay, so I've taken up. You can see from 2020 till 2024. Hope the Excel is visible, everybody. Okay, so which one we are supposed to be taking up? Open, high, low, close, adjusted close. Which price we should be considering and why?
Close price, because NAVs are calculated on close, so that's why we do.
Okay. So in previous session, we have actually taken up close because there was no adjusted close there. Here adjusted close has come up. So because of this, adjusted close is much more reliable than close. I'll tell you why adjusted close should be taken. And what is adjusted close means? It is actually accounted for split and bonuses. Understanding what I'm saying? If at all company has got splitted, if the share price has been got splitted, so that is actually taken into consideration. Adjusted close will be adjusted for that split and bonuses. Okay, so because of which we should be taking adjusted close. Okay, supposing that if adjusted close is not there, then you can choose close. That's it. Is it clear, everybody? Since adjusted close is given here, I am just copying this and I am moving this to my main sheet. So I am writing it as SBI. And I am writing it as beta. For this sheet, I'll be calling it as cost of capital sheet it is. So tell me beta, for computation of beta, what two values are required for us?
X and Y.
X and Y. What is X for us? This SBI is what value for us? This is Y, right?
Hmm.
Can you tell me what is X here? We have discussed in the last class.
Reference
Market.
value.
Pardon?
Market like Sensex or
Or
something.
maybe index value.
Nifty.
Index value. So shall we take Nifty 50?
Yes, sir.
So I'll close this. So I'll put here Nifty. So this has come up, you can see. You can click on Nifty 50 and click on historical data here. Come down, come down. Same, it should not be changed there. So 2020, I'll take it up. I'll click on done. So now I'll take weekly frequency. Both should be same. So now I click on download. So I click on download. So I have got adjusted close here. I'll copy this and I paste here and I call this as Nifty 50 and this is my X. Fine. Until this, everybody with me?
Yes, sir.
Now, quickly we compute, how to compute beta now, if you know the stock prices. Yeah, quick, any answers? How to compute beta now with the stock prices? You discussed this in the last class, right?
Sir, in SBI, the first value is not matching, 159.
Means
Sir,
here
can you just show us the base sheet? You have taken the data weekly basis.
weekly, yes.
They will showing 305 in my sheet.
You'll have to match the date. It was 2020, 11 May.
2020
May, 11th May.
No, it was
start
five.
date.
It was 5-year data, na?
5 years data.
2019.
Mine is matching, but
Yeah,
Mine
it
is
was,
not matching.
it was 11th May 2020.
Hey, you want me to mail this?
Which date, sir, you have taken? Just
I have
want to
taken
know.
10th of May 2020. 11th May, you can say. 11th May 2020.
I'll just
That
show
was
you
it.
can see. 12th
Yes,
May
yes.
2020 to 12th
12th May 2020, not 20.
So 2020 to 2024, it is 5 years, right? Just check. 21, 22, 23, 24. 4 years, sir. It's only 4 years.
4
I'm
years.
taking.
Yes, 4 years.
So I think we have to take 2019. Is it fine? It is fine. Actually, I've understood now how to do it. Okay. So I
Yeah.
should have taken 5 years here, but by mistake, I have taken only 4 years data. Okay. So that is the reason it is not matching. You can
Okay, sir, no problem.
what is it?
Concept is same.
Concept is going to be
That's
same.
it.
Yeah. So how to compute now next?
The slope.
Sir, we need to find the correlation between the X and Y first.
Why? We can directly compute the beta, right?
Direct slope, sir.
Direct slope is there, no?
No.
But while you do the slope, what is X and Y?
Aren't these
Returns slope. Isn't it?
returns this?
So we are actually doing it on the price, which is very wrong. So can we quickly take up the returns now? So returns is this one minus previous one divided by previous one, right? Oh, everybody getting this, right? You just not did for many times. So this is return series, right? So this is Y and this is X, we know it. So what we should do now is you put slope function and go for X, comma, Y, enter, we got some answer. And this is the beta. Is it clear, everybody?
Yes.
Beta. For your own companies, this is how we should be doing it while doing project. So now we have computed beta. So 1.66, I go right here, 1.66. Next comes the return of the market. So what is the return of the market here? So beta weekly values for the last 5 years, right? I made a mistake of taking 4 years, but for your real company, when you do it, you take for 5 years weekly data. Is it fine? Now, next is what is the return of the market? This is the Nifty's return, Nifty 50's return since from the inception. Okay, so when Nifty 50 is formulated, so I'll go to National Stock Exchange because easily available there. So Nifty 50 index historical data nseindia.com. So I click on NSE India's website link here. So I'll go for the second link. Let me try with the second link. So Nifty 50, select a period it is coming.
What should be the duration of this?
Since from the
Historical.
inception, since from the inception it should be taking. I think it is not working. So let us take a break and come back. Is it fine?
Yeah.
Is it fine?
Yes, sir.
Right.
Yes, sir. Thank you, sir.
Yes.
Thank you.